get started here. First of all, thank you all for joining today's Legal Value Network webinar. The title is Modeling Litigation Funding Agreements, Negotiating Fair Outcomes for Clients and Firms. This is a very interesting topic, so I'm looking forward to hearing what our panelists have to say. But before we get into the details on the program, a little bit of introduction info. My name is Keith Mazierick. I'm the Director of Pricing and Legal Project Management at Catton Nugent Rosenman. And I'm also a board member for Legal Value Network. So obviously, as a board member of LVN, I've got a little bit of a bias to plug the organization a little bit at the front end. So just in my capacity as a board member and also as an active member of the community, I'd just like to encourage everyone who has not yet joined Legal Value Network to join as a member. We recognize, the whole board recognizes that it's a difficult time for a lot of folks, and membership dues are maybe not the top priority for a lot of your budget. So, in acknowledgement of that, we do have a couple of opportunities or membership categories that you can take advantage of that offer complimentary membership for the rest of 2020. And with those complimentary memberships, you'll still receive access to all of the content that we're putting out, the webinars and other programs that we are making available to our members, as well as to the public. You'll start seeing more things go to members only programming as we move forward here too. So there will be benefits to being under the tent, as you might, as they say. So we'd love to have everybody part of the community. In addition to, the messaging around the complimentary memberships, just to clarify, that applies for everyone, for clients, for law firm members, and also for vendors and service providers out there. So we've got classifications for each one of those stakeholder groups. And just to reiterate, clients are always free, actually, right? So now, now is as good a time as ever to take advantage, and that clients will never have any dues to pay after that. So if you do have the ability to pay dues for the remainder of 2020, you will be awarded what we're calling founding member status, and that carries with it additional discounts for future programming that will be kicking off, both live programming and other benefits that we're putting out there that would carry additional costs with them. So founding membership has its benefits too. In particular, one thing we're excited about is next year's first annual LVN annual conference that we'll be releasing more information on soon. But that's one of the things that you'll enjoy a discount on. So in addition to those things, just, events and programming, the benefits that we're trying to put out in the community, all the thought leadership is really meant to bring everyone together and to be sharing and developing best practices. So we've been doing that so far through the webinars that we've been putting out there, like the one, that you'll see today, as well as some of the more recent titles, going deep on law firm profitability, Law Firm Economics 101, and then we also had a look at client-side AI-powered legal spend analytics tools. All those were really, very popular programs and are just sort of indicative of the type of programming we're looking to continue putting out there for the benefit of the community and to engage everyone out there. So you can find those programs, by the way, on our website, legalvaluenetwork.com, under the Thought Leadership tab, and you'll find a bunch of other content there as well that's probably of interest, including take a look at the counsel luminaries notes. Those are some very interesting and engaging thoughts and sort of commentary on things going on in the industry from recognized leaders. So in addition to the things we've been doing so far, we'll be moving more towards other engagement opportunities that will be available to members, roundtables, different groups and forums. In particular, a couple things to look out for in the very near future. We're kicking off our LVN Labs initiative, which are going to be project groups that are going to be dedicated to developing solutions and best practices and playbooks, if you will, for some of the challenges that are recognized throughout our community by members as things that we need to make some progress on to move the profession forward. So the first LVN Labs project groups are kicking off very soon. And we're also having our first annual LVN survey, which will be quite interesting because it's bringing together data from the client side as well as the law firm side to show where there's disconnects. And we're doing that in collaboration with the Blickstein Group's annual LDO survey. So that's really exciting. We're happy about that. So all those things said, that's sort of the end of my promotional message. But I do, on the LVN behalf anyway, I do have a couple of housekeeping items that I have to mention as well. First of all, the only video feed you'll see is the panelists, so nobody else will be appearing on your screen. Everyone is on mute except for the panelists, which probably won't be a surprise to you. The event will be recorded and available on our website as well, along with the other ones that I mentioned on the Thought Leadership tab. And we obviously, as always, encourage you to ask questions and engage, but we're going to hold the questions till the end of the event to make sure we get through the content that we want to. So with all that said, I'm very excited to introduce today's panel, or actually today's program, and by way of our sponsor, Validity Finance. So Validity offers clients and law firms the financial resources needed to keep their businesses operating smoothly during lengthy legal battles. Validity is backed by $400 million of available capital from a global investment management firm. And clients use the capital to pay for some or all of the cost of litigation, such as attorney's fees, discovery expenses, expert witness fees, and court costs. They provide clients and law firms with the financial resources and strategic advice needed to help ensure complex legal disputes are resolved on their merits. So here today to tell us more and introduce the panel and get things kicked off is Kate Boyd, friend of mine, friend of LVN's. She is the Chief Engagement Officer at Validity Finance. Kate, thank you again for your support, and we look forward to today's program. I'll kick it off to you, and thanks again.
Thank you, Keith, and thank you to the LVN team who helped us put this together. As Keith mentioned, Validity provides capital to companies and law firms to pursue and defend meritorious legal actions. One of the things I wanted to really quickly share is what our mission is and why we do this. The team at Validity is almost entirely alumni of big law firms. We understand the sophistication, risks, and costs needed to deliver a complex litigation strategy. We respect the importance of maintaining independence, but also helping sustain profitability for the legal practitioners and the businesses working to resolve their disputes. We are a client-focused organization. We want to find a way to deliver solutions with clarity and transparency. We want to serve as business partners and trusted advisors from the moment we send a term sheet, which we'll discuss today, through the duration of a dispute. As a big law alumni myself, I believe we have an opportunity with this network and the people speaking on the panel today to use funding to make progress toward a legal industry that's more efficient and more fair. I hope as you listen to our speakers, you'll feel the same. Today's program is modeling litigation funding agreements, as Keith said. Since the outset of the pandemic, demand for funding among leading law firms and in-house teams has dramatically increased as companies of all types look to protect their balance sheets, maintain legal actions in progress, and resolve disputes. We designed this webinar to pull back the curtain on how litigation funders and law firms can assess and model legal investments. To help us in this, we're joined by Jordan Aily, my colleague at Validity, who's our Director of Finance and Operations. Jordan is responsible for managing our financial commitments and helping our team deliver on our mission to build a client-first funding organization. Jordan joined the company after 4 years at Apollo Investment Corporation, where he was the controller of Merck's Aviation Finance, which grew to a $2 billion portfolio with his oversight. Prior to Apollo, Jordan worked as a senior associate at Ways & Measures, handling audits, taxes, and due diligence for privately held domestic clients and publicly traded foreign clients. Jordan is a certified public accountant licensed by the state of New York. We also have Alan Guy, Managing Director for Underwriting and Value Optimization at Kobre & Kim. Alan has experience underwriting, negotiating, and managing litigation finance and alternative fee arrangements, developing strategic partnerships, and practicing as a litigator at Cravath and at Freshfields, Brookhouse, and Derringer. Prior to joining Kobre & Kim, Alan was Managing Director at Van & Capital, where he helped to launch the U.S. operations of the Global Litigation Funder. Alan earned his JD at Northwestern University and his BA at NYU. Finally, we're joined by Alex Macdonald, Chief Client Value and Practice Management Officer at McCarter English, where he's responsible for leading the firm's client innovation, value, pricing, legal project management, and practice group management functions. Prior to his current position at McCarter, Alex was the co-architect of a team focused on the optimization of firm practices to align client value expectations at Venable. He held a management role at Seyfarth Shaw, and he has years of experience as a successful legal industry consultant. Alex is a frequent provider of lectures and continuing legal education seminars on the topics of law firm management, legal accounting and pricing, legal technology and innovation. Alex earned his JD at Cleveland Marshall College of Law. Thank you, Jordan, Alan, and Alex, for sharing your wisdom with our audience today, and I'll hand over to Jordan to take us away.
Great, thank you, Kate. Thank you, Elvian. To get started here, our agenda is basically that we'll start with a brief overview, Litigation Finance 101. We'll move on to some considerations if you're seeking funding. Then we'll discuss modeling. I'll present a model that's very similar to the type of model that Validity typically shares with its clients and law firms before finalizing a deal. And finally, we'll end with takeaways. So Litigation Finance 101. We're going to start with a survey just so we can get a sense of the makeup of the audience and how familiar they are with funding. So we're just going to give it a little bit of time here to give people a chance to answer this survey question.
I'm disappointed, Jordan, that the pop-up says that the host and panelists cannot vote.
Yeah.
We could skew the data if we could.
My vote's in the mail.
Seems like most people are aware, but. Okay, great. So that's helpful in giving us a sense of the makeup of the audience for sure.
It's also not surprising, right? I don't know what you guys think, but you know, it's kind of what I would expect.
I think I have funded a case or more, 27%. I think it's actually on the higher side for a lot of.
I agree. That's more than I expected. Okay, so let's keep rolling here. An overview of litigation finance. Litigation finance is a transaction where the litigation claim secures the financing. The funds are provided on a non-recourse basis. So this is significantly different than taking out a loan where the client would have an obligation to repay even if the litigation is unsuccessful. In a litigation finance transaction, the client doesn't owe anything if the case ends up being unsuccessful. This slide gets into a couple different types of litigation finance. Generally, we're trying to focus on business-to-business commercial disputes. On the left side here are a couple of different case types that we typically see. But again, we're aiming to focus on business-to-business commercial disputes. Who uses litigation finance? Small to mid-sized companies, law firms, and large corporations as well. And this slide I wanted to spend a little bit more time on. As a director of finance and operations, I happen to be one of the only people at Validity who hasn't worked at a law firm before. But it's not difficult for me to imagine a situation in which a client approaches a law firm with a really strong case that has substantial damages, but the client just doesn't have the liquidity right now to pay the legal fees. So maybe the client was hoping that that you'd be willing to take the case on a full contingency in exchange for a sizable piece of the final resolution. And for illustrative purposes right now, let's just assume that the client was willing to give up 40% of the case. The client wanted to keep 60% of the case, but was willing to give away 40% of the case if the lawyers were willing to do it on a full contingency. And maybe this case is so great that you are willing to do it on a full contingency, but for any number of reasons, and I'm sure there are tons, you're just not in a position right now to be able to offer to do it on a full contingency. So clients in a tough spot because they deserve access to justice, even though they're not flush with cash right now. And you as a law firm are also in a tough spot because you have a great opportunity in front of you, but you're not able to do it for free right now. So litigation finance exists to give another option. And here's the proposed solution. Just bear with me for a minute. When I was in high school, I had a job going door to door selling kitchen knives. And I had two options. I could work completely on commission and I would get a big piece of every sale I made, but no guaranteed money if I didn't sell any knives. Or I could opt for a base plus commission. So I did have some guaranteed money up front. And though my commission was smaller, I still got a nice check every time I made a sale. So me personally, I'm more risk averse. I opted for base plus commission. and sort of bring it back, the proposed solution is that instead of doing the case on a full contingency, where you stand to earn 40% of the resolution, maybe it's more feasible to earn half of your normal fees, the base, so to speak, and because you're getting that base, you can afford to take half of the fee that you would normally earn on the back end. So instead of getting 40% commission on the back end, you're willing to take home 20% in exchange for that base. So you still stand to earn a nice check on the final resolution, but there's a lot more certainty on the front end, knowing that at the very least you're collecting half of your normal fees. So in this situation, Validity or some other funder could come in and provide that capital. So you can still earn a portion of those fees in the front end. And in exchange, the funder is going to take the other 20% of that recovery on the back end. And so after all of that, the client ends up exactly where they hope to be. Despite the lack of liquidity, the client's walking away with 60% of the resolution, and they have great lawyers working their case. And that's exactly what this chart is showing here, basically, that Validity as the funder is investing 50% of the fee budget. The law firm is taking 50% of the fee budget. We're hoping that the client is able to pay some portion of the case, but the important part here is that the client is walking away with 60% of the recovery, and the remaining 40% is split between the law firm and the funder.
And Jordan, maybe I'll just interject some color commentary here real quick. Put another way, that 50% for many of you who are in the law firm world is the way we look at it tends to be covering our direct cost. You know, if you're willing to just do the work at cost, you know, this becomes a viable opportunity for you, and that's why it makes it significant, because you still have that, as Jordan put it, that check plus opportunity, that premium at the end of the day, while working the case at least cost.
Yeah, I think what we've seen as one of the advantages of this is that it reduces, it just smooths your revenue over time. You're not landing the 1 year where you have a big case resolution. You're flush with cash that you then typically have to distribute and push out of the law firm almost right away. You can spread that revenue over multiple years, which just makes cost management and headcount management a lot easier.
One clarifying point too for everybody that I just made when I say direct cost, I'm excluding overhead from that. I'm fully recognizing that many of your margins, once you pump in overhead, is a lot less than 50%.
So moving on to this next slide here, we're just putting some numbers to those ideas. We're assuming here that the full legal budget would have been $4 million. And in the top section, you'll see that the funder is investing half of that, $2 million, with that money going to the law firm as the case progresses. And on the cost side, we're hoping that the client is able to contribute to some extent. In this example, we're assuming $1 million cost budget, with the client covering 10%, the funder covering 9%. And upon a successful resolution, the client's walking away with 60% of the pie, and the remaining 40% is split between the funder and the law firm. And in the event of an unsuccessful resolution, the client doesn't owe anything. The last slide of this section is just meant to introduce another product offered by funders different than the single case model. This involves a funder investing in the law firm's contingency interest of a group or a portfolio of cases. We don't want to get into too much detail on this, but just to introduce the idea here that another product exists for firms that maybe have or are interested in having more contingency cases, and they're interested in sharing some, but not all of that risk.
Yeah, we had a good question, Jordan, I think that might be worth talking about from John Dunn. He'd asked, you know, if your firm has an AFA with a client, would the firm essentially function as a funder? And I think this we'll talk a little bit more about this later, but I think John's question hits an important point, which I just want to dwell on for a second, which is that, you know, if you look at, we won't give you a full history lesson on litigation funding, but, you know, essentially where it started were in jurisdictions where you couldn't have law firms doing traditional contingency fee arrangements, the UK, Australia. And so litigation funders came in because law firms had to be paid on an hourly basis. And if you're doing class action litigation, for example, it was pretty hard to pass the hat around to an entire class of litigants to get paid. And so it grew to essentially mirror what you'd see with traditional contingency fee litigation here in the US. And so, litigation finance, when we're talking about litigation finance, what we typically mean is third-party litigation funding, right? Where an outside capital source comes in. But really, it's just one type of litigation finance that exists on a spectrum that starts with, right, the corporation or the client using whatever their existing financing mechanisms are to pay for litigation, through the law firm, essentially acting as a funder, right? Fronting the costs and legal fees on the case, all the way to third-party litigation funding, where you have an outside capital source coming in and providing non-recourse cash or a non-recourse credit facility to fund the litigation. So the firms are traditionally in America, firms have been the largest providers of litigation funding other than clients themselves. And what third-party litigation funding has done is really allowed law firms that didn't traditionally play in that market to start doing more of that work, and also allowed law firms that maybe weren't capitalized to take on a case fully on contingency, or take on the cases they really wanted to do on full contingency, to start playing in that area based on the quality of their cases, and not based on sort of the amount of cash they could scrounge together to get something up and running at the beginning of their case. I don't know if we're going to touch on that later, Jordan, but I thought it's worth mentioning that now, just to orient everybody.
Yeah, I completely agree, and I think it's also a nice segue into the next section, Alan, that we're going to talk with all of you about, which is how to identify these cases, how to intake them, how to identify the opportunities, the questions you need to ask yourself as a business, as Alan mentioned, what are the strategies that you're trying to accomplish. And before we begin that, I'd like to, first of all, take the opportunity to thank LBN for having us here today. Certainly want to recognize the continued times that we're all in, and appreciate that although these webinars are becoming more and more normal, they're not the typical way that we've gotten to engage with each other professionally. Certainly hope that all of your work families are doing well, your real families are doing well, and a special shout out to all my fellow parents who are continuing to juggle children and school issues and daycare and all of that while maintaining busy professional lives. I hope you're doing well in all of that. If we could move to the next slide, Jordan, we're going to do our next survey. What we're really trying to gauge here is, for those of you who are either law firm pricing people or have some role in this, or whether you're maybe a partner at a law firm who's attending here today, whether or not your firm is structured to intake these types of cases. As Alan mentioned, many firms are have not typically taken contingencies, or at best it was ad hoc. Certainly we only saw that 20-some% of you had ever done litigation finance before, but interested to see whether or not there's a formal process in place for all of that to happen, so that we can tailor our comments over the next several slides with the appropriate takeaways for all of you. So I don't see whether or not on my end, actually, whether or not we have a critical mass. Jordan, I don't know if you see that as the host, but if you think we do, we could certainly show the results.
I think we've got 44% of people voted at this point.
Okay, well, maybe we give it just another second to let people answer the question, because it's a really, it's a really important one. And there's no one-size-fits-all intake process. And we could do another probably 2 hours on the considerations for thinking about intake. What we're really trying to get to are the particular questions that you should ask around litigation finance opportunities, which, if you're going to play in this space, to any degree, you should be thinking about what process and form that takes. So, to me, a little bit surprising in these results that 60% of folks have a committee and a process in place to evaluate. I'm going to assume, based upon the 27% that we had in the initial question, that this is probably relevant more to contingency cases, but really, in many ways, the opportunities remain the same. If you go to the next slide, Jordan, one of the things I was going to mention is that as Alan and I, with Jordan's interjection, go through these next several sections, we're going to use a lot of terms that might sound transactional in nature or businessy jargon in nature. If we say something that doesn't make sense, feel free to put it into the Q&A. Kate will either interrupt us or one of the other panelists will interrupt us to clarify. If it's something that can wait till the end, we'll clarify it then. But wanted to make sure that we threw that out there as well. But the key takeaway here for me is one that Jordan was making, and I think Alan already made as well, is this final statement about litigation funding is just one tool to help lawyers manage risk and develop client relationships. That's certainly how we view it at McCarter English. I joined the firm not just shy of 2 years ago, I guess. And really, we were not a firm that was structured to take on contingency cases, let alone litigation finance cases. But one of the things that I hope you take away from a seminar like this is that these are new revenue opportunities for your firm. They are diversification of revenue, if nothing else, as Alan mentioned, to help smooth out some of those potential drops and cyclical drops that we can see with litigation. And the typical way that these would have come to us before in the past would have been one of two ways. The first way being, a client either runs out of funds for litigation and asks us midway through the case to revert to a contingency, which sometimes catches the law firm off guard. But more commonly, these probably came to us with a client who was either undercapitalized or didn't have liquidity to bring a litigation. And that pulls on my personal heartstrings a little bit, because I see that as an access to justice situation. For those of you who've spent any amount of time with clients like that, you'll know that there's a calculation that a lot of big companies will make in terms of whether or not they can get away with trampling on some of these smaller players in their industry. And before a solution like litigation finance was around, they very likely could get away with that, because they understood that there was going to be a high percentage of folks who were either undercapitalized or didn't have the liquidity to take them on. So not only is this an opportunity for your firm to diversify your revenue stream, it's also an opportunity to provide greater access to justice to an underserved market, while at the same time providing outsized returns to investors, being the litigation finance company. So it really is an opportunity to create this win-win-win, especially if you're a firm like McCarter English, who is never going to be structured such that we take a lot of contingencies onto our balance sheet. So keep that in mind. I think that last point there is most important. If we could go to the next slide. Alan, I'm going to toss this one to you, because I think your firm has a pretty robust and mature intake process for this. And perhaps after you go through how you approach these questions at your firm, I can supplement it with how we're developing our own strategy and our own approach at McCarter English.
Sure. So, again, I'd also like to thank Validity for the invitation, and LVN for setting this up. I think it's always valuable to have people talking about litigation finance in an interactive setting. I mean, there's obviously a lot of coverage on law.com and in the legal press, but I think until you actually have a conversation about it, it's sometimes easy to focus on sort of some of the policy arguments about it and not really get into the nitty gritty of it and understand how you can use it in your practice. Kobre and Kim is a firm that focuses on disputes and investigations. We don't have a transactional practice. The firm was, firm legend basically, starts with, Steve and Michael starting the firm in Steve's kitchen. And the great moment of the firm's early years was the moment when we decided effectively to fire all of our financial institution clients and then turn around and sue them. And the reason that we did that, the reason that they did that, I've been with the firm for about a year, but the reason that they did that was that they'd had a lot of success engaging with big institutional clients, and they found that as those relationships deepened, the institutional clients started asking for more and more discounts, right? And what they were doing, they realized essentially was a really good job at commodity work, right? And so their ability to price was just, it was being driven down to their cost of production. And so they rethought, the firm's approach. We still are focusing on disputes and investigations, but what we're really trying to do is the stuff that no one else is either able to do or wants to do, and doing that really, really well. So right now, we do a lot with defense work. We also do a lot with international private clients, and we do a ton of work in the asset recovery space and international judgment enforcement space. And so we've got a strategy team that I think is now about 30 plus people. And we hire in analysts who work effectively as a combination of a first-year associate / paralegal right out of college for 2 years. And then they either go into law school or they come up into our strategy function once they've learned the ropes. And these are the sort of people who'd be analysts at a hedge fund or an investment bank. They have that kind of flexible, interest in law, but not necessarily a law degree. And each one of them owns a product area. So one person will be responsible for owning IP litigation, right? And they'll work with the partners who do IP litigation and firm leadership to develop a strategy in that area, and to develop criteria for the kinds of cases we do, and also the kind of cases we don't want to do. And so whenever we have a new potential new matter come in, there's a Slack channel and some internal firm, IT solutions where this gets circulated to all the relevant decision makers. There's, criteria that we've developed in conjunction with the attorneys to sort between the opportunities that we want to pursue and the opportunities we want to write immediately as a referral to another firm with whom we have a good relationship that might be better suited. And as we're doing that, we're always trying to figure out, what is the client's real problem here? Because if a client knows what their solution is or what their problem is, they're going to take that problem to you and 3 or 4 other firms. And so we're always trying to figure out how to redefine that so that we're a one-of-one solution, right? So we've understood their problem in a way that they don't even understand. But once it's explained to them, they get, what their real issue is, and they get how we can solve that. And we see the financing side as just an extension of that. What is your real problem? For some firms, they're concerned about costs, right? Some clients are concerned about costs. They don't want to lay out a huge amount of money to pursue a claim. Other clients may be very willing to spend the money, but frankly, probably shouldn't, because it's not a good, if you're a startup, as a startup, it's never a good use of your money if you want to grow as a business, spend a ton of money on litigation. If there's other places you can draw the funding from. And so we're always looking to craft a solution that combines a legal solution with a financial solution that ultimately, helps drive the client's business. And as we're doing that, we're always looking at the conflict profile in a case. We're always looking at, the upside for us in terms of revenue, profit, but also, what is the downside, right? If we're going to have to do this on some sort of alternative fee arrangement basis, what is that going to cost us in terms of fees that we have to front? How does that fit with everything else we're doing? And so, we've invested a lot of time into figuring all this stuff out within the firm. And, one thing that we've found is that the process of funding a case can be very educational for partners who maybe aren't as familiar with these issues, because the litigation funders are thinking about these issues in the same ways. And once you've done a couple of these deals, you can bring a lot of that knowledge and experience in-house. In our case, I came over from a funder, but a lot of law firms have just developed this ability in-house by having internal champions that focus on things like intaking cases, for example, or figuring out the financial solutions for cases. And we've learned a lot from our relationships with litigation funders about how they're doing that, because there's obviously multiple ways to sort of sort this. And so we always find these discussions to be quite valuable in terms of thinking about new ways to approach the problem.
Yeah, the only thing I would supplement there, Alan, is on that number 1 bullet point here is the case in a strategic area. Given that we're, really only as a firm about a year and a half into really pushing into this space in terms of creating, creating the pipeline of litigation finance matters in our portfolio, we identified, 4 key areas within our firm that we were going to predominantly try to balance our portfolio against. And the first one being patent litigation, which is a key strategic area of our litigation practice, given that we have one of the largest intellectual property litigation groups in the Am Law. Second for us was insurance coverage. For those of you who are in firms that have not given up the policyholder practice and do maintain a policyholder practice, insurance coverage tends to be a space where you can find a lot of traction. Now, a lot of policyholders prefer to fund their own litigation, especially for large claims, those long tail claims. But there's this whole segment of claims that we've found where the policyholder deems them to be almost nuisance and would not bring them but for the opportunity to have them financed non-recourse by a third party, or for the firm to take them on contingency. The third area for us is our Delaware commercial litigation practice. For those of you familiar with the Delaware Chancery Court, you probably understand the opportunity there on the plaintiff side. And the last being what Alan mentioned, which is the emerging growth company. Completely agree that there's generally not a good spend of cash to be litigating if you're a company that's in the growth stage. And oftentimes, those litigations still are not brought, at least in our experience, but the value in having the conversation with the client and presenting them the opportunity, educating them on these alternative sources of capital for litigation goes a long way just in the value toolkit in terms of, building a relationship with a client that, you hope becomes successful, and certainly a long-term client, especially for a firm like ours that does have transactional practices, which is generally where we make our money in working with those clients. So otherwise, our process aspires to be what Alan had with analysts that own particular space. I certainly would love to push us in that direction, but as of now, we fall much more when evaluating these cases, much more in the ad hoc category. It's generally myself, a couple partners who understand the space and have sort of general intake responsibility for the firm that are evaluating these against our strategy. But certainly think the approach, Alan, you guys have put in place is probably the best way to do it from my perspective for a firm that's going to play heavily in either contingency investments or in finance deals.
Yeah, I think one thing that you mentioned about setting your strategic priorities, I think is really important, because I think the way that most law firms are structured and the way that the legal market functions, by the time someone's made partner or is in a business generating role, there's almost a Pavlovian response, right? client has potential matter, and just everything is go, 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 go. And I think what we've worked on is trying to interrupt that. And we spend a lot of time educating the partners and other business generators about, what to chase and what not to chase. Because ultimately, when you always want the client to call you, and I think this was a lesson I learned when I was actually in the funding world, is people come back when you say no right away, right? It's when you go down the road with them a while and then you say it can't work out that there tend to be hard feelings. But if you give someone a quick no on a contingency matter, and then refer to someone who might be able to take it on, or just tell them, listen, there's no point in pursuing this at all, they tend to come back. And so you avoid sinking a whole bunch of time into potential new matters that aren't going to go anywhere if you just get an efficient and confident decision-making process in place. And that's obviously a lot easier said than done, but I think it's something that any firm can strive to, and I think clients really respond to.
I think that's also a nice segue into to the next slide, which really talks about how our firms or understanding really how your firm makes these decisions. Because Alan's point there, if you get too far along, or your partners get too far along the process and having these conversations with clients only to then have to come back to them and say no, or my firm's not interested, or this doesn't fit into our strategic approach, or there's no way in heck my firm will take this on a contingency. You're really setting yourself up to have a very difficult conversation with the client. You're certainly not setting them up to be a client that's going to come back to you or leave with warm and fuzzies about how the evaluation of their matter was handled. So not only is it important to have those intake protocols in place to help evaluate these cases, it's important to understand that what it's going to take to get it to the finish line. So Alan, how does your firm approach that question?
Yeah, so I mean, I think what we're looking at is always to bring the right amount of scrutiny in relation to the risk. So we have, an internal champion for litigation finance, which is me, but we also have, the two named partners, and then three what we call green partners, and I won't get into the history of that name, but three additional partners that can make that are authorized to make decisions up to certain dollar amounts of risk on AFAs and on litigation funding. And so, we use, as a repeat player and as someone who sees all of our terms and all of our deals, I'm sort of I'm the technical expert on it. And the partners that have this authorization are able to make risk-based decisions, with my guidance. And, when we get to large enough matters, it's a number of partners, and then parts of the firm management, or CFO, or chief strategy officer. And the goal is to have a formal process for approving things, but also to have periodically a recap of all the things we've done, so that people can get a sense of what the other folks are doing, and we can also realize oh, that deal looked like a good one at the time, but perhaps in retrospect didn't for these reasons. And so we try to internalize all the lessons we're learning. We don't typically work with specialized transaction counsel on funding agreements, although I know some firms do refer that out. We typically will disclose potential conflicts issues, and we'll talk about that in a second. But different firms have different processes, and I think the most important thing is just making sure that anyone who's negotiating one of these agreements within your firm understands all the hoops that are going to have to be jumped through internally, just so you don't end up negotiating a deal with the funder and then having to retrade terms with either the funder or the client because some important approval was missed.
Yeah, our process isn't too dissimilar. We do, I think, have less flexibility, probably because we're more nascent really in the space than your firm. We don't have any thresholds that any partner or any pricing administrator has the ability to sign off on without centralized approvals. So typically speaking, as the champion internally, I'm brought into every deal at the intake stage, work alongside the partner who's has the relationship in terms of negotiating the deal, along with a couple other of the partners that I referenced earlier in our intake world to help determine firm risk. And then ultimately, I work alongside our internal transaction counsel, to help paper the deal, get it closed. Should we get the terms, which we'll talk about that process here in just a second, and with ultimate approval resting in our firm and our executive committee, which is a committee of 6 of our most senior partners. So it's a little less flexible than I think than what you've described. Part of the reason being, we want to make sure early on we understand and are thinking about how we're balanced across those 4 strategic areas that I referenced, and we have sort of an internal distribution for how we want to throw our risk around. And so the only way for us at this point to kind of continue to go waist deep into the water is by making sure that the same people are looking at the deals each and every time in order to help evaluate those opportunities on a macro sense versus just looking at each individual opportunity. But otherwise, I think the process is relatively the same. And I'll echo the sentiment that it's critically important to make sure that your partners understand that process. If for nothing else, you know, it's a very difficult conversation for them to have to go back and say, you know, all these conversations we've been having about alternative funding solutions and, you know, the ways my firm can take on your case have just been shut down by the firm. It's not a good position to put yourself in. So we go to the next. Oh, Jordan, before we leave this though, I did want to pose a question to you, kind of on that last point that I was just making. I think we'd be remiss if we left this topic without getting your perspective on, you know, perhaps that scenario that I described, having a conversation with somebody at a firm only to find out that they had no clue what their internal process was, and, you know, the impact that that has, you know, has on both how you view the deal and also perhaps how you might view the firm.
Certainly, yeah. And obviously, when we're looking at cases, ultimately, we're trying to move the process along as efficiently as possible because time is usually of the essence. So we're hoping that our initial intake calls involve a sufficient amount of detail that we can identify all the major risk areas and that we don't have many surprises come up at the end. But yeah, it's certainly very difficult when it turns out that there were things that were missed initially, and we only find that out later, and then we might need to, you know, change term sheets and reassess how we look at this from a risk perspective. It's certainly not ideal, you know, from our perspective.
Move on to the next slide. And we won't spend a lot of time, you know, being mindful of where we're at in the agenda, but just also know that there's a lot of other issues that you need to take into consideration that go beyond, you know, that go beyond the considerations we've been talking about. There are definitely state-by-state issues with champerty maintenance and disclosure rules. There are certain states that we just completely avoid, and I'd be interested to hear from Alan and Jordan if they do the same thing because of those issues. Hot off the presses are the ABA guidelines, which just came out on this topic, which I encourage you to read, in particular the sections that sort of highlight and underscore the duty of the firm to, we always put it in writing, tell the client that they're a party to this deal, the law firm's a party to this deal, the funder's a party to this deal, the law firm is not representing them in the negotiation of this deal, and so they should be encouraged to either have their in-house counsel or get separate transaction counsel to review the deal, and it makes sense for the law firm to get that in writing and underscore that as a means of mitigating potential liability. But a variety of these types of things that you should be talking to your general counsel or your transaction counsel about before, you know, getting too far down the road. And in particular on the state-by-state question, you know, before we hop off of it real quick, are there any jurisdictions that you all like to avoid? For example, Kentucky for us is a non-starter, but interested if you guys have any others that you want to throw in.
Yeah, I mean, I think we don't have any bright line rules because I think there's always the option of doing something as an AFA if we really like it. And between, you know, most, you know, jurisdictions typically will either allow you to do both AFAs and funding or one or the other. And when I say that, we're frequently, the jurisdictions that don't allow contingency work are typically overseas. But I think you can almost always find a solution if you've got a creative funder and you think about it for a little bit of time. But I think the ABA guidelines are good. I know some funders have taken issue with certain components of them, but I think if you're at a law firm and you're trying to get internal decision makers comfortable with litigation finance as a solution, or a client comfortable with litigation finance as a solution, they're a really good place to start the conversation because I think they give a very good sort of 30,000 foot view. And the fact that they're put out by the ABA, I think will get people who, you know, may be a little squeamish about this whole concept, comfortable with it fairly quickly.
And the other thing that I forgot to reference for those of you who in particular are interested in patent litigation, the TC Heartland case that came out, I guess now a couple years ago, did a lot of things, but of course one of the things that it did was change the, you know, the venue issues, and so these state by state situations come up a lot more than they used to in the patent litigation space, and it's certainly been one that we've struggled with as we've tried to identify these cases, as well as unfortunately caused some inflation in budgets, which has made the litigation more expensive, which could be seen as an opportunity for more of these cases to be brought into litigation finance, but also make them more expensive for the funders and law firms to take on. So why don't we move on? So Alan, funding agreements. You want to start us off?
Yeah, so I can take over this, and I'm conscious we're short on time, so I'm going to move through this pretty quickly. With an eye toward leaving a little bit of time for Q&A. But funding agreements typically follow typically have that general structure that we talked about earlier, with a certain amount of the fees being paid by the funder, a certain amount of the risk being taken on by the law firm and the client, and then a distribution of the proceeds from litigation coming out of that. The funding process typically starts with an NDA being signed between the law firm and the funder. That helps you with some of the disclosure issues that can come up when you're sharing confidential information about a case, which you will need to do to get the funder comfortable with investing it. This is something you need to do, in consultation with your clients, because it's obviously, the privileges and protections run to them. But typically that initial discussion will end in a term sheet where the client offers you, where the funder offers either the law firm, the client, or both, the high level economic terms on which they'll proceed. And that's really your price for the funding, right? Typically when the term sheet comes a request for a period of exclusivity. And that's because the funder at that point is actually going to invest some real money, often with outside counsel, to vet the legal issues related to a case. While that's happening, they'll typically negotiate the actual funding agreement. And then ultimately the diligence and the funding agreement will go to a funder's investment committee or something similar that'll greenlight the whole thing. You then sign the agreement, and then there's some ongoing monitoring obligations. And this whole process, the amount of time it takes varies. I've heard of things being done in a week. I've heard of things dragging on for a year. Typically, you're dealing with a couple of months. Often, a lot of that time is tied up with, short bursts of activity where everybody's talking, and then longer periods where a client or another decision maker is sort of mulling over something. But normally, if you're thinking, do I have enough time to do this? You've got a couple months. You can usually put something like this together. And so often, as a law firm, you'll need to think about whether or not you can work out some sort of interim arrangement for a case. If the client really needs to get into court right away, you may want to take it on a contingency first and then convert it, or you may want to take it on some sort of hybrid arrangement. But I think the important thing is make sure you have that NDA in place, because that's really, I think, right out of the gate, your biggest concern is just making sure you protect the confidentiality of the discussions. And if you've got a funder that's getting too far into things without talking about an NDA, it's a pretty good sign that maybe you need to be thinking about whether you're working with someone who really understands what they're doing in this space, because it's quite important. Beyond that, everybody's process differs. Some people will take a long time to do a term sheet and then do short diligence. Some people will do a term sheet right away and then want long diligence. The most important thing, I think, is just to talk to the funder and make sure you've got clear expectations as to what's going to happen, and then hold the funder to those. I think most funders appreciate that law firms and clients are under a lot of pressure, but funders are juggling a lot of deals as well, and so it never hurts to speak up. So I think, just given the time, why don't we flip ahead to the model, because I know we talked about.
If I could add one thing there, just about term sheets in particular. Understand your funder too. The good funders have deployable capital like Validity, and aren't going to get you under an exclusive term sheet and then go try to raise the money. So just be cognizant of that before you sign a term sheet, that it would be my strong recommendation that you only deal with funders that have deployable capital ready to go.
Yeah, no, I agree entirely. So why don't we flip ahead? These are some, we've talked about some of the key terms, but this is in the deck if you want to look at it. One thing I'd encourage everybody to do, if you're looking at litigation funding, if your firm doesn't have a way to create financial models for cases, spend some time and just draw a simple grid, right? And lay out the key terms of a funding agreement, and then map out sort of who gets what, depending on the various outcomes. I mean, this is just something I, sort of back of the envelope thing that I did, but it's actually pretty similar to sort of the summary that we'll often present to decision makers at our firm when we're looking at something. And what we're really mapping is what's called the waterfall, which is, at the end of the case, how does the money get distributed? And so you start with whatever the gross recovery is, right? What's the total amount of money that's coming in the door on a case? Typically, money will have to go back to the funder first. They'll want to recover their invested capital, and then there's a net recovery that gets divided up between the funder, the law firm, and the client. A lot of different funders will have different sort of ways of structuring their premium, but a fairly common one is the greater of a multiple or a percentage. And the multiples, multiple applied to the amount invested, and a percentage is the percentage of the recovery. And if you spend a little time with this, you can see that at different points in the case, the multiple bites versus the percentage. And one thing this does is it creates an incentive for both the law firm and the client to think carefully about advancing to the next stage of a case and spending a bunch of money, which frankly can benefit the law firm as much as the funder, because if you've ever had a case on full contingency, the client's often willing to roll the dice and be aggressive, versus taking what might be a very good settlement offer, because really it's no skin off their back. If you spend a bunch of money to get ready for trial, and then they settle, it doesn't cost them any more. And so, thinking through how these different terms apply in different scenarios will help you avoid, one, unpleasant surprises, and two, just you have an obligation to counsel your client about this stuff as you go through a case. And doing this kind of map at the beginning will, one, give you confidence about what's ultimately going to happen, and two, will help you identify if there's any issue with the terms or there's any scenario that perhaps you haven't anticipated, that you really need to think about further, and either work that out in the funding agreement before it's signed, or it may be an issue where you just have to decide this isn't the right deal for us. But I think it takes 20, 30 minutes to do this. And if you're having trouble doing it, ask the funder to do it for you, right? This is, if a funder won't tell you what it's going to cost, that's something to think about when you decide whether or not you're going to enter into a multi-year relationship with them that also involves your clients.
And that's one of the things that we really pride ourselves on is that level of transparency. Just as a sort of quick example, this is an example of something that we would typically provide to our clients when we're considering a term sheet. This enables you to plug in different scenarios for proceeds and duration, and you can see that even under what we would consider a relatively healthy return, we still have the client walking away with the lion's share, and that's achievable if the funding amount is equal to, basically we're looking for that to be equal to around 10 times the damages. So in this situation, it's a little less, but the resolution is earlier, and the client walks away with a healthy share. In this situation, it's exactly 10 times the funding amount, and the client walks away with 60%. In this case, it's a little more, but we're generally there in all those situations. And this is just an example, to your point of ensuring that there's transparency around that process and having the funder do that. That's just an example of the type of thing that we would provide in those situations.
The last thing I'd add is reciprocate that transparency. Don't keep things from the funder that may be defects in the case. You're going to want to build those relationships with them. Certainly, it's an investment of the firm as well. So you're only putting firm resources also at risk. That transparency is something that you should cherish and value from your finance partner. But often you have to convince your partners. Trust me, I've been in the seat. to be as transparent and reciprocate that. There it is.
Right. So those are some of our key takeaways to ensure that you know your funders, being transparent, understand how to model, and Alan's point, if it's not something that you're so comfortable with, then feel free to ask the funder to do it for you, and that should be something that they're willing to do.
Thank you guys so much. This is Kate. We do have 2 open questions, but I do realize that we're a couple minutes over our allotted time. Janet's asking me to come back on the camera. Angela asked a really key question that I think is worth us just quickly clarifying. She wants to understand whether the NDA and the exclusivity tie the firm to one funder. And I think this is important. Something we certainly encourage is that firms speak to a number of different funders to make sure they understand what their options are. Jordan or Alex or Alan, do you want to quickly address this?
There's a quick answer to that. The NDA does not typically bind you to one funder. You can enter into NDAs with multiple funders to talk about the case. Be careful about the terms in those NDAs so that you don't make some of those communications discoverable. And so you want to talk to your GC or transaction counsel about that. But the terms do. Once you receive terms and execute those terms with the funder, there is going to be a period, typically 30, 45 days of exclusivity, where you're only negotiating with that funder, giving them an opportunity to do their final diligence and pay for the deal.
Yeah, I think anyone who's asking you for exclusivity before they've given you economics that's a huge red flag. Same thing with people who are asking you to pay for their diligence up front. That's also, it's either a sign that the funder's undercapitalized or they really don't like your case. I think typically funders will take, unless you've told them that it's a hurry up rush job, they'll typically take a week or 2 to give you terms, and that's actually a good thing because it means they really thought about it. Somebody who gets you a term sheet at the end of the initial conversation, they really don't understand your case, right? I mean, it takes you as a firm at least a week or 2 to understand it, and you want to give the funder that an amount of time to really get their heads around it. And I think when I was in the funder role, frankly, I hated it when people told me that I was the only person they were talking to, because one, I was never really sure. I doubted that it was actually true, and if it was, it's not really a situation you want to be in as a funder, because if you can't offer them something, it means you just wasted a couple weeks of their time. And ideally, as a law firm, you should be talking to a couple of different funders. You don't need to shop it to 20 people, but have a couple of funders that will deal with your clients well, that can give you decisions quickly and shop things to them, and then come back with a couple different options, because different funders will have different risk appetites, and validity may be the solution for one case, and they may not be exactly the right solution for the next one. But I don't think any funder is going to be, I think funders would love to have an opportunity to compete for your business, but it's no one's going to take it personally if you don't come to them with every single case.
All right, Christy's asking some really good questions about weighing the financial capabilities of the client versus the viability of the case. I have some opinions on this, but I'd like to go ahead and ask the panelists to go ahead and speak to her questions, if we can do so in just a minute or so.
So, I don't know that I fully understand the question, but I will say this. I mean, obviously the financial capabilities of the client to bring the case is often the reason that the case is being, that you're shopping the case for litigation finance in the first place. It's not the exclusive reason, but it is certainly often a reason that you have an undercapitalized or low liquid client who needs money in order to bring the case. And so, I don't know that that really matters to the funder, Jordan, from an investment opportunity, whether or not the client has money or does not have money to bring the case. But one of the things that we haven't talked about is that I have an opinion that you usually want a viable, healthy client, who's moving along through litigation. And oftentimes, especially when you're dealing either with startups or with small practicing entities who might have patents that are being infringed, there's a need for those clients to receive or need working capital for them to hire employees or for them to pay vendors off who help them develop the technology. And that is something that you can ask your funder for. You can ask your funder. Many funders will provide working capital to keep those clients viable, to keep those clients up and running, because a financially healthy client going through the litigation is often important for everybody, the law firm, certainly the client, and the funder.
Yeah, I think ultimately, whenever we're looking at a case, we're doing some assessment of the risk level. And having a client that we think is, in poor financial condition, it's just something that gets contributed, that we're trying to take account of in assessing what the risk is and what level of return do we need in order to take on that risk. It's less risky if we feel more comfortable about the client's financial health. But to that point about working capital, that's, we have several cases in which working capital is a part of the funding. And we know that that's an important part of the equation because it keeps the client in a healthy place and helps to protect our investment in a sense.
Yeah, I think all that's right on. I think for us, as a law firm and in my prior role, really the question is what is it going to look like 6 months into the litigation, right? Is the client going to want to renegotiate terms with the funder? You just want to anticipate these issues and address them up front. I think there's a perception, at least, that litigation funding is only a solution for undercapitalized clients. And if you guys at law firms have been getting the same letters that I think everybody in the industry is getting from clients who, it usually starts with COVID-19 and ends with requiring discounts. Nobody has too much money, right? No client has too much money. I mean, if you think about banks, right, they're banks, but if you talk to their chief legal officers, they're always looking for ways to be more efficient. So I think this is something that you want to surface with any client, not just clients that are obviously in financial distress. And it's a conversation you want to have, I think, frankly, in relation to every case, even if it doesn't go very far, right? If you don't bring this up, the client may not think about it, they may not appreciate it, and it may take a couple tries before suddenly they realize, oh wait, I should have explored the funding opportunity on that last case. I'll do that now. There's another question here, just since we're short on time, that I'll front, which is, is there a conflict of issue from the funded side? Conflicts, you talk about, the question talks about, small businesses usually need to sue very big companies. Those companies often, have created a broad conflict profile that makes it tough for those folks to get counsel. I mean, there's a couple of different issues there. One is just the conflict issues of negotiating a funding agreement, which I think the ABA guidance actually provides a nice roadmap for how to address those and deal with those. Because as a law firm, if you're negotiating an agreement on behalf of your client, you're also negotiating an agreement that's going to benefit you. So you need to make sure that you've made the proper disclosures under your state's rules. In terms of conflict profiles, I think most funders that I'm aware of typically take the view that they are not a law firm, they are financial solutions, and so they have no qualms about funding company A in one dispute against company B, and would fund company B in another dispute against company A, so long as the two outcomes weren't directly correlated. Obviously there's a business component to that, but I think for most funders, they're not going to take the same approach to conflicts that law firms do, because they don't have the same relationships to clients that law firms do, right? They're a financial solution, not an advocate, not a lawyer. I think in terms of creating opportunities for smaller firms with lower conflict profiles. I mean, I think that's a great story for why funding works, right? If you're a smaller law firm, you don't have the ability to front a huge case, have the skill set needed to run a large case, and you can demonstrate that to the funder. I think that's a great situation to be in as a smaller practice, because you can use your skills to compete with a much larger opponent, because you've got the access to cash that you'll need to retain the experts, and, handle the discovery, etc.
I'll leave it there, but I will say we've had some internal conversations about the publicly traded litigation funds that may have stock owned by a potential target of the litigation, and whether or not there's disclosure and conflicts issues for the fund and funding litigation against one of their shareholders. But I'll leave it there. But generally speaking, I would agree that the conflict issue is not the same.
Yeah.
Fantastic. Panelists and attendees, conscious of time, we do have a couple extra questions. We will reach out to the Legal Value Network team, offer some answers, and they will go ahead and share those with those of you whose questions we didn't get to. As promised, Jordan's simplified model we will be happy to make available, so we'll be working to share that. And really, thank you, panelists, thank you, attendees. What a great discussion. I really appreciate it. Thank you, Anne, for hosting us today.
Thank you, everybody.
Thank you, guys.
Thank you. Have a good afternoon.